Welcome to the Rigatoni Capital podcast. I'm your host, Colin. It is the morning of March 31st, pre-market, and it's very sunny here on Wall Street, and I think it's going to get a little warm today. So as you can see, because of the weather, stocks are green this morning. And yeah, I think we were a little oversold, to be honest with you. And I was expecting that bounce to come on Monday. We kind of got it, but they sold the rally. They sold the rally. And then this morning, Warren Buffett's on CNBC. Did anybody know he was scheduled to be on CNBC this morning with Becky Quick? I didn't know, so I'm just assuming that it's either a surprise or that I didn't know he was supposed to be on. Worst case scenario is, unfortunately, sometimes when we were getting these last minute interviews with Charlie Munger, it was due to his health. I'm not saying that's the reason why. I'm just saying, Warren Buffett's in a nice sweater. I've never seen him in a sweater before with a white t-shirt under it. He's definitely chilling and enjoying his part-time work. Now, he had some breaking news in the morning here. One of them was that he bought $17 billion worth of treasury bills this week. That's not really a big deal. What's a big deal is that he said he didn't think that the stock market was down that much, and he kind of mocked the idea that 10% was something to be concerned about. He reminds us that Berkshire has been down over 50% 3 times in his career there. He suggests that if the market were to pull back, he would definitely deploy cash. But right now, he doesn't really see anything that has sparked his interest, and he's making it seem like, the value's just not there on deploying money, and it depends on which stock pulls back the most and which stocks pull back, and he'll analyze it at that time. Definitely really basic stuff he's saying. He really simplifies the idea of how he invests. And, it's a breath of fresh air to listen to Warren Buffett in the morning because, a lot of the stuff we listen to is like all the complicated stuff like zero hedge, talking about, currency exchange rates and war news and complicated options, the options market, the derivative market, and all this stuff feels like so overwhelming. But I think all of those headlines are geared towards traders, short-term investors, short-term traders, and the people that are passive, long-term, more value type of investors that really don't want to deploy any cash until there's a significant pullback in buying something under its intrinsic value. We have to listen to all those headlines that sound like smart people are talking, and they are smart people, but we're playing a completely different game. And, it really doesn't matter what WTI and Brent are going to trade today, to be honest. So, and then I guess maybe there has been some news overnight. I know we hit, as in the U.S. and Israel, really hit that one city in Iran pretty bad, or pretty hard over last night. So I don't know if that's why. I know Hegseth is on the press conference right now. Maybe there are some things that we're trying to work through in terms of telling the media that the war is almost over, which I think is gaslighting. I think that the U.S. had made a mistake here. At this point, it seems like that the U.S. bit off a little more it could chew. Is that the saying? And, I am quite disappointed in how things have been working out over there. I'm not saying I'm for or against the war. I'm just saying I'm disappointed. That's all I'm going to say. Okay, so let's look at everything. Like I said, is bouncing. Bitcoin is pretty much flat, though. And silver, gold have done a little bounce here. And something like the NASDAQ 100 is up only almost over 1% this morning. So big pre-market rally. And why don't I have, see, I can't see what the S&P is trading. Let's fix that. The S&P is up pre-market. It's saying 1.2%. Let's see what WTI is doing. WTI has just come down from like 109 or something to 104. So you would think that maybe that has something to do with it. And, I'm looking at Google's now up 277, and something like, let's look at Microsoft, which I'm not interested in buying, is up 364 pre-market from 358 yesterday. So this big rebound could be sold. We don't know. We might have a really strong day today, and then we eventually come back down over the next few days. Like they sell the rally, but it takes longer to sell the rally. I think we're going to see a little bit slower volume around Easter, Good Friday. The market's closed. But who cares, right? We're not traders. We have to pick and choose when we deploy cash. We are professional by the dippers here at Rigatoni Capital. Professional by the dippers doesn't mean we have to buy when there's a 10% pullback, but it means our interest is peaked. Our interest is peaked. I'm going to play you this video real quick, even though I forget what it's about, but let's check it out and it'll refresh my memory because I do chart prep the night before, so I don't even know what this video is on, but it will remind me.
Alphabet 9, Microsoft 5. Let's just get to Weiss's thing real quick, since you sort of teased it, and then we'll move from there. But
Weiss
you trimmed
on
Microsoft.
why he
I asked
keeps
you
trimming
the other day,
Microsoft stock.
The stock's been horrible. Whether you were thinking about, if anybody who owned it that day that was on the show, anybody thinking about selling it, and you said, yeah, I have trimmed it.
I've been thinking about selling it for a while, knowing full well that I could be making a short-term bottom in it, so I kept some of it. I didn't sell it all. But look, I just don't see the fundamental catalyst to get it higher. It could continue to bounce if the market bounces, but frankly, I'm exhausted by it. The software debate's going to continue for quite some time. I don't like the missteps they've had in AI so far. I don't parallel it to Google, Alphabet, where they were working on it, and something came to fruition. So I think at this point, that I'd rather have a very small position in it than have as big a position as I did.
Guys, what do you think? I mean, some would look at this and say, well, maybe this is emblematic that...
So Stephen Weiss is a trader. He's not a long-term investor like you and I are. He is always hedging and in and out. But what he had mentioned about Microsoft as a long-term investor is how I felt. And I have been talking about Microsoft being a concern for me because it's such a large market cap stock, and how hard the stock has gotten hit, and how I still don't find it interesting as a long-term investment today due to the era of AI. I think Microsoft is concerning. And that brought me to the idea of, again, yesterday, the title of the show is the reason I'm not buying the 10% dip yet. And a lot of it had to do with the idea is just because you hit 10%, and this is what QTR Research, who is, pretty much like a bearish type of investor, Chris Irons, he is still a really good writer, though. I just, I don't agree with everything he says, but here I agree with everything he said in terms of why he says just because you hit 10%, that is a mental, psychological pullback, but it doesn't mean you have to deploy. And obviously he just kind of gives you like basic stuff like, stocks can drop, the market can drop 50, 70, 90%. Like there is no end to it. And then you have someone like Ben from the Compound, I can't remember Ben's last name, saying like, no, this is actually a good time to buy. Or Joseph Carlson on his big YouTube channel is saying like, actually don't make this mistake. Like it's okay to buy a 10% dip. I'm going to tell you what I have done is Ben Carlson. Sorry. What I have done is sometimes I buy the 10% dip and sometimes I don't. It depends on how much cash I have to deploy. It depends on the actual situation of the pullback, which is really not a good reason to explain, because it's always a bad reason. So you're always going to be fearful to buy the dip. But I can promise you, I have bought a 10% correction. I just didn't want to buy this one. And part of it is because of my personal situation, not having a lot of cash on the sideline, number one. And number two, is that I don't like this Microsoft situation. I think the AI disruption story hasn't finished yet. And I believe that is more of a problem than the actual US-Iran war. I think they're both also entangled. You know, they everything is entangled too. I'll try to explain it a little bit here. I'll give you 5 reasons on, and almost investors that know too much. And it's like Succession, that meme when the son is telling the wife, like, you're too online, like, because she's afraid to go outside because of the rioters or the protesters or Antifa or something. And he's like, chill, you're almost too online. And the same is true for investing. Like, you don't want to be too knowledgeable, because then you'll be fearful of too many things. Like, if you know too much, you'll always be too scared to buy the dip, but I really like the idea of definitely like holding your nose when you're scared and buying like that. Usually when you're scared, it's a good time to buy. But here's some of the reasons why I didn't buy the dip yesterday. And unfortunately, I knew we were going to get this short-term bounce. That may have been the bottom, and I would have to come on here and tell you, like, hey, like, I told you guys I wasn't buying that dip, and I missed it. And that would suck, because it makes me look less credible, right? So AI disruption and fear and the white collar recession, all kind of, I'm not saying we're in a white collar recession. We definitely have an issue that's kind of forming. We don't really know how true it is. Definitely, there's like almost like a fog of war and this AI disruption story too. But I had Claude help me write this a little bit, so hopefully they don't put words into my mouth. The market is pricing in real white collar anxiety around Microsoft, SaaS, and broad AI driven job displacement. See, I wouldn't have said that. We're not getting job displacement yet. We're getting actual job cuts. There is no displacement yet. And it's part of the problem I'm concerned about too, is that, displacement comes after the bad job growth or the, we've had zero job growth, but job displacement, meaning that new sectors get created. That's how I understand it. That doesn't happen until there's job destruction. So we have to go through the job destruction part first. When knowledge, this isn't irrational. See, this is Claude talking, and I don't know why they talk so stupid. This isn't irrational. It's a real repricing of labor and software economics. I would have never said that. When knowledge workers are being displaced or feel threatened, I hate AI LLMs. Okay. My point about AI disruption, remember, this is one of the 5 reasons why I didn't buy the dip. And I think AI disruption is the biggest story. Now, AI disruption also overlaps into the private equity market issue, the private credit bubble we've had, when, these investors can't get out of their software positions, because software is getting disrupted by AI, and a lot of these companies that are privately owned that were maybe even going to IPO at some point this year, those investments have been destroyed because of Claude, because of AI disruption. Like, AI eats AI. AI software companies are being eaten by AI, okay? Because there's no moat. Like, Claude can do what Harvey, the lawyer AI app, can do. Okay. So that's one aspect of it. And then there's this other aspect, which I'll discuss as the American Express aspect. American Express is an example of high income professionals and small business owners. So there is these businesses, small businesses have these American Express cards. and you see that that type of spend tightens up. So either, the high income professional or the small business professional, like that could hurt American Express. People may have to get off of American Express, or they're trapped. If there's all these job cuts in the white collar world because of AI disruption, you would think that less people have an American Express card, and then they talk about BDCs and all of that crap. So that's the one issue, and the biggest concern I have is Microsoft. I need to reread a investment thesis or a bull thesis on Microsoft because I simply forget why Microsoft is valued this high, other than Azure is really growing fast, and Azure, the cloud, is a pretty good, valuable, high margin type of sticky business. That I understand. But I rather just buy. I already own Amazon. I like AWS. I like the idea of AWS better than Azure. So why wouldn't I just hold on to Amazon? What is the catalyst for me to buy Microsoft? If you think you know why Microsoft is such a great business, then let me know. I haven't done my research on it lately. Like I said, I bought it 10 years ago. I sold it last year, and I made out great, and I'm going to have to pay the taxes on that this year, long-term capital gains tax. I just don't know what the catalyst is on Microsoft anymore in the world of Claude and AI and Perplexity and, all of this stuff. Okay, the Iran war is number 2, but what does that really mean? Yeah, we don't want to be in a war, and it's scary and it sucks, but the Strait of Hormuz is obviously something that someone like me, who's not a geopolitical or geographical expert, didn't realize how dependent the globe and the global trade is. So reliant on the Strait of Hormuz, and then obviously this has to do with input costs, and we're going to have a spike in inflation. I also think that if the U.S. has to cower and walk away with its tail under its legs, what kind of signal does that give to the rest of the world? And, after, what kind of signal does that give to Palantir investors? How does that affect China's leverage over the U.S. in the trade war? Those are the questions we don't know. So there's a lot of uncertainty. That's what war brings, is uncertainty. And I don't know how this ends yet. We still don't understand how this ends. Is this like COVID, where they're telling you to get all these booster shots and stay home to stop the spread? And really, it was like we were being lied to from the government. Is the Trump administration lying to us about this Iran situation? Did we make a mistake, is what I'm trying to say. Number 3, a contradictory Federal Reserve. I'm not too sure that the current Federal Reserve is contradictory. They are they stick with the game plan over there to try to achieve 2% inflation. My uncertainty or contradictory comes with Federal Reserve Kevin Warsh, and how I'm still unsure what the heck his idea is in terms of he wants to cut rates. So he's kind of he's only hawkish when it comes to expanding the federal balance, in terms of not increasing the federal balance sheet, expanding the federal balance sheet. He wants to, obviously not do QE, and he's against QE, but he wants to cut rates at the same time. And, just a lot of confusion. And usually when you get a new Fed chair, the market tests the Fed chair the first few quarters or the first few press conferences, because it doesn't understand what it's supposed to do. It's like almost like a rookie pitcher comes in, and he's a little shaky in the first few press conferences or when they have to meet. Okay, so I have that as a reason why I think people are kind of uncertain. And the U.S.-China Cold War needs a handshake. Yeah, until there is some kind of deal that I believe is necessary, where they both become friendly competitors again. They need to become friendly competitors again. For example, what I would expect is what I would be happy about as a long-term investor is to see a handshake on where we stop these chip export controls over there, where we can open up our chip market to them and allow them to get some of these high-end AI chips and say, is that what you want? Then here are here's Blackwell, here's Rubin. I guess that's never going to happen. But I'm saying that that's what I would think would be necessary to get China to then agree on their refined rare earth export controls, to loosen those, and then we can buy silver from them, or we can buy all these crazy refined rare earth materials to be able to build things again. I really think that's a big problem, that China is able to have leverage over like something like, and they can just say, okay, well, you're not going to get your refined rare earths. We don't know the specifics of that. Nobody does. I'm just saying that whole situation, this whole Cold War situation, realizing that China has the leverage it does over refined rare earths, is really important. It was an important aspect of something that we realized late last year, and I think the stock market hit highs in October 2020, and the refined rare earth situation. I don't know when that happened, when we realized there were these, when everybody was like, oh wait, yeah, they have all those refined rare earths, and if they don't want to sell it to us, they don't have to. I don't know if that was around the time where the market sold off. I can't remember. Last thing, and the least concerning issue for me, is the Mag 7 or the hyperscaler capex spend having no visible ceiling. The AI infrastructure build out continues while the Mag 7 can afford it for now. The market wants to see tapering until there's an end in sight on capex. The street will discount earnings power. Yeah, you see everybody's free cash flow going down except for Apple and all that stuff. Less shareholder returns in the short time, less dividends, not less dividends, but less share repurchases. The stock buybacks aren't going to be as strong. And so, yeah, all of these things. So that's why, and obviously, when I look at my watch list, I want really high quality stuff. And that is what the mainstream type of media says, or the investing media is like, yeah, if you're going to buy, make sure you buy something that's like cash rich and healthy. Obviously, you don't want to buy something that doesn't have, that's not profitable yet. And it's like, well, no shit. Like, why would you have been buying something that's not profitable anyway? That's because, the more speculative you get, because you think they're going to tip the scale in the future, and therefore you can pick the next Amazon or the next Netflix or something like that. So I'll show you my 2026 watch list if you can see it. Palantir, I already bought Palantir. Of course, I'm getting whacked. But like, look at the ITA. The ITA is something that really is interesting, because we're in the middle of this Iranian war, and it really ran up before the war, and then look at how it's doing. It's kissing the 200-day. Why would ITA, the aerospace and defense ETF, be selling off like this? Does anybody know? So I tried to do a little bit of research, and I decided that I wanted to look at the ETF holdings, and I see, hey, look, GE is 19% of the entire ETF, and GE has been selling off quite a bit. And we can pull it up here. And all the defense manufacturers have sold off, kind of like sell the news type of thing. Northrop Grumman, RTX, Lockheed Martin have kind of pulled back at some point in the middle of the war. Like, they kind of went up and then they kind of go down. That's pretty normal, in my opinion. But like something like GE to sell off like this, why? The answer is why. And you guys probably know more than me on why GE is selling off. Look at General Electric. They have total revenue all messed up because of all the spinoffs they had. So they had all of this. They were annually hitting revenue something that's really higher today. Like we're at 45 billion today, but back in 2016, they were hitting 120 billion, but then they spun off all of those businesses that were unhealthy and unprofitable. And the spin-offs obviously allowed each company to then start being profitable again. And the GE part of the company is, the GE aerospace side of the business. And you can see like how well, and in this picture I'm showing you how well services revenue is doing, and how the equipment revenue is 13 billion last year in revenue they did on the actual equipment. And then on all of the services revenue, which is what they call that, the MRO, is that what they call it? So look at how the services business is 30.4 billion, kind of like a beast, right? And definitely, I think the stock was kind of trading pretty expensive there. It says a PE ratio trailing was 34.75 on GE, and that's as of today with the pull. And the pullback, I tried to do a little research. The only thing I can understand is that yes, it has been a very good stock, so maybe it kind of got ahead of itself. But the surging raw material and energy costs, they affect GE, and input costs in general. The supply chain and logistics surcharges, all of that hits margin. All of that hits all of these defense manufacturers and something like GE as well. GE, I guess, technically is a defense manufacturer too, but the ones that we know, the RTX, the Lockheed Martins, they're going to get hit with input costs and inflation as well. But I think that I'm not saying I would buy GE, but I'm saying I'm interested in buying the ITA, and I'm happy to get exposure with GE in the ITA. So the ITA is something that I was considering buying today. But, the fact that we got this little bump, this rebound from, because, I see the ITA is trading at 213 per share. It was at 210 yesterday. The fact that we got this little bump makes me a little less interested in buying it. It's kind of like, I'm not trying to buy the bump. It's really not that much of a bump, right? But yeah, I'm interested in ITA. And this is me, who owns individually all of these names except for GE and Boeing, but I own Northrop Grumman. Let's look at the holdings of ITA. The holdings of ITA, we got GE is 19.6%. And then, like I was saying yesterday, there's probably a cap on this type of ETF where if GE ends up being a larger, more than 25% of the ETF holding, I guess they cap it and they have to automatically sell it. We don't know that structure for ITA, but you have to accept that. RTX, Boeing, Lockheed Martin, Northrop Grumman, L3 Harris, General Dynamics, TransDigm. I own like most of those stocks individually. Okay. So, and I'm bullish the ITA for very long term. Something you buy and hold forever. And you have to hold it through a cyclical situation where, a certain political party wins and they're not into defense spending, for example. Okay. So, and I'm not saying that'll ever happen again because both sides want war. All right. So let's move on from the ITA. I just kind of wanted to talk a little bit about GE, and, I had all these notes to write, to discuss on GE, and I guess I'm not going to get to it this morning. Now, just a quick heads up. Red Eye Returns is on Substack, and he is posting a lot of good stuff on there. I'm a subscriber to Red Eye Returns, and this is a good post on Broadcom, and it's titled Custom Silicon is Winning. Here's who wins with it. Definitely Broadcom is something to keep an eye on for myself because I don't own it. And I haven't been paying attention to it because NVIDIA is my largest holding. Like I said, I'm up like 3,800% on NVIDIA. I've owned it forever. It's become my one top holding. So Broadcom is something I've accepted that I missed the run in Broadcom because probably a lot of my intention was on something like Nvidia. But yeah, I like Broadcom. I just don't know if I'm ready to buy this pullback on Broadcom. But definitely good reminder on how Broadcom is going to continue to do well, we think. And he thinks as well, or he or she thinks as well. Red Eye returns. Good post. Check it out on Substack. Another good post was from Nick from who writes Compounding Alpha. I had mentioned his newsletter, I think 2 days ago. This one was a deep dive on Texas Pacific Land, TPL. So cool how TPL makes their money on like literally just owning the land, and then how, you know, they're like the toll that anybody that wants to transfer oil or gas has to pay the toll, right? They have to pay TPL a fee, and let's see what they got here. TPL also owns hundreds of miles of water pipelines because they also own the surface rights. They don't have to pay for right-of-way easements like their competitors do, giving them structural margin advantage. I just did like a quick valuation on TPL last night. I don't know if I was looking at it incorrectly or not. I really didn't spend a lot of time on it, but it does seem like a very expensive company, but that doesn't mean that it's not out of whack. It just means the market's valuing it as something that is kind of like safe and that they're going to continue to do well, and they will always do well. So, you know, I think like what I'm saying is like their price to sales seemed out of whack, but that doesn't matter. Their market cap is $32 billion according to fiscal. And, you know, they're not even hitting $1 billion in annual revenue. So that brings their price to sales ratio. Their EV sales next 12 months is 31 times. Let's look at, I don't know. I'm not going to do this right now, but hey, you know, this guy, Nick, who writes Compounding Alpha, should just come on the podcast and teach me about this stock, Texas Pacific Land, TPL, which I've known about TPL, but I haven't really done a lot of research on it. It says with software-like net margins exceeding 60%, a debt-free balance sheet, and a newly minted spot in the S&P 500, TPL is no longer just a land story. It's a high-velocity capital allocation machine. So maybe I'm misunderstanding the business a little bit here because I don't know why their annual revenue is so small. Do you guys know? Okay, guys, we're going to get through this. I'm pretty much done here. I also want to mention that Kevin, also known as Bag Holder, who writes the Substack newsletter, My Two Cents, just posted a post on the gold market update. Pretty interesting. Not to put words into his mouth, but he seems like this is a buy the dip opportunity for gold, which is really interesting. You know, Bag Holder knows gold more than anybody I know on Substack. So definitely check out his newsletter on Substack. Again, it's Bag Holder on Substack, and his newsletter is My Two Cents. I think he's coming on the podcast in about a week or two, and we'll talk to him about this post, and we're going to talk to him about Bitcoin as well. You know, he's a fan of Bitcoin and gold and oil stocks, and maybe we can even ask him if he's familiar with TPL a little bit. All right. And yeah, that's it. So my recommendation is to check out this Warren Buffett interview, which Becky Quick did with him this morning, which was kind of a surprise. It's over now. It probably went from 8 a.m. to 9 a.m. East Coast time. And, you know, I'm watching CNBC right now, and now Jensen Huang's on there saying he's investing $2 billion in Marvell. So definitely want to check out this Warren Buffett interview. And, you know, you learn so much, and he keeps investing simple. I don't think Wall Street likes him to make it sound so simple, because investing really is that simple. All you're doing is just buying something buying a business below its intrinsic value. And I know it's hard to understand what the intrinsic value is, and everybody does all these crazy discounted cash flow analysis, and they come up with whatever's comfortable for them to consider that something's on sale and something's trading below its value. That's all that means. But I think that you're still making it overcomplicated. If you understand the business a little bit and you did a good amount of research on it and you see a big sell-off in that business and you kind of understand that maybe it's being wrapped into some kind of uncertainty that will eventually resolve itself, like the Iran war, then I think it's a good time to buy the business. Just keep it simple. All right, guys, thanks so much. Rigatoni Capital's on Substack, YouTube, Spotify, and everything else. Thank you so much.